Thanks everyone for joining. I think this is the right time to have this webinar where obviously everyone has sort of done their tax returns, hopefully paid their taxes, and it's always one of those tasks I hate to do, but everybody has to do it. Tax has to be paid, but what I'm going to talk today about is important, especially for the audience who are joining us. It's how you can save that tax or save part of the tax that you've paid, right? So there's tax planning that we can do, which involves investments, but I'll obviously more of that later. But again, today's objectives, I'm going to talk about savings instruments that are out there in the market that give you this tax efficiency, and overall how you can sort of better manage your taxes, how you can get some tax relief by investing into certain things, and of course be very tax savvy, right? That's the whole point of today. So there are a few instruments out there that the government has incentivized from a tax perspective, right? And they all have to do with investing. So investing means there is risk there, where you're investing your capital. Risk taking comes with getting returns at the same time. There's capacity for loss, so your capital is at risk, and so you need to note that. ISAs is a personal savings instrument where the government has said, okay, you can put £20,000 into a ISA every year, and any returns you make on that investment, where you can have your ISA as a cash ISA, or you can have your ISA as a stocks and shares ISA. Any dividends or interest you receive is tax-free, right? I'll talk more of ISAs later, but pensions is something I'll speak more of. Again, I'll concentrate on personal pension contributions because that's what effectively gives some of this tax relief that I spoke about earlier. Business relief, I won't touch much on this, but it has to do with inheritance tax planning. So it's not very relevant to today's webinar, but it's a vehicle there which is mainly used for inheritance tax. But today I want to talk a lot more about venture capital, and VCT and EIS schemes are part of venture capital schemes. Now, these are instruments that a lot of our clientele use, so business owners, limited company directors, not only them, but people who are higher rate taxpayers can use these instruments to get some tax relief, right? And I'll show you how all that works. But a little bit about what venture capital actually is. So venture capital is where investors are pooling together to put their money into early stage companies. So these are, these companies have high growth potential, and they are in industries that the government wants to promote, like hybrid energy. You talk about healthcare, technology, and so these sectors are where small companies are with a lot of potential to grow. The government wants to have financing going their way. So investors, the HMRC and the government want to promote these industries. So they give tax incentives, right? And so venture capital, for example, Facebook, before it went listed, it was backed by a venture capitalist, and that venture capitalist made, it was, I think, 200 times what they initially invested in when this was IPO'd. Google again was a venture capital backed company which went IPO. So all these big names that we hear, like the Facebooks and the Googles, have initially been backed by venture capital. So there's a lot of scope here for making high returns. At the same time, these are high risk, high return type investments, right? So yes, so high risk, but offers the potential of exponential returns. When I say more than just money, again, venture capital is putting money into smaller companies which have the potential, but also you can't just look at it as just getting returns, but you're helping an industry, you're helping the creation of jobs. And when it comes to healthcare, a lot of these companies that are in this sector are, they've come up with products that are disruptive, that will change the market for the better, right? So it's more than just money. That's sort of the idea there. We have to talk about risks. So venture capital, this is a graph with risk versus return. For example, cash, you can hold your savings as cash, and cash, gives you an interest rate, which in the spectrum of asset classes is the lowest level of risk, right? Followed by bonds. Obviously, government bonds are backed by the government, so there's not much capital risk there. But of course, you get an interest rate, and so on and so forth. Property, equities are shares of companies, so they carry a lot of risk because companies can go bust, right? But equities also give you the most potential for returns. And so they are higher on the risk spectrum. So the higher the risk, higher the return, higher the capacity for loss. So hence why high risk, high return, higher the capacity for loss comes in. And you see venture capital is right up there. So it's there because what I'm going to talk about, the smaller companies, they carry the most amount of risk. So the capacity for loss is far higher, right? So you must note that. It's not for everybody. Venture capital is not for everyone. It depends on how much risk you're able to take, and of course, how much money out of your total wealth you're putting into products like this. So that's a very important slide to note. So I said I'll speak a lot about venture capital and EIS schemes. So VCT and EIS schemes. So VCT is again a very tax incentivized product that is backed by the revenue and the government, right? It is so consider it like a fund. So let me just take it to the second slide. So this explains it. But consider a VCT like a fund, like a normal. You're investing your pensions into funds, right? So consider it as a fund where it's the fund has invested into multiple companies. So here you see below, this fund, this VCT fund, it comprises of so many companies, small to medium-sized companies. If I take one of the biggest VCTs in the UK called the Titan Fund, which is run by Octopus, that's got about 115 companies. And when you invest into this Titan Fund, you buy units of the fund. So you don't buy individual shares, but you buy units of it, of the fund itself. So you can have multiple, therefore you can have multiple investors, right? So I can have a piece of Titan, you can have a piece of Titan. So there'll be many individuals holding units of the Titan Fund. And those units give you exposure to this pool of small to medium-sized companies who are in these sectors that I spoke about, the tech sector, the healthcare sector, the solar, energy sector, and all that. And so there are different types of companies in these funds. Now, the tax benefits. So when you invest into a VCT, you get tax relief. So, for example, if you invest £10,000 into a VCT investment, the HMRC gives you 30% income tax back. So 30% of the investment value. So that's £3,000 coming back as a tax refund. I'll show you this in an example, in a calculation. But so one way to recoup some of that tax you paid this year is to invest some money into these sort of instruments. So VCT being one of them, right? Now, a point to note, when you invest that 10,000 into a VCT, it's locked. It's locked for 5 years. So you can't sort of encash it. It's there. It's locked for a reason, because obviously the reason why the revenue and the government is tax incentivizing these investments is because they want this money to be there with these companies for a longer duration, right? So it's locked for 5 years. You get 30% back on year one, But every year, these VCTs they give you a return, and it's in the form of dividends, and usually now the Titan fund over the last 11 years has given an average of 5% tax-free dividends. So any returns you get off a VCT is tax-free, and it obviously doesn't form part of your tax return because it's tax-free. So that's another sort of tax incentive. And when you after 5 years, when you encash this investment, and if you made gains, so your 10,000 becomes say 15,000, there's no capital gains tax. So another incentive for saving, right? And so growth is tax free. You get 30% income tax relief at year one, and of course every year when you get a dividend, that's also tax free. So VCTs are, in my view, a first step into exploring this venture capital environment, because it gives you access to, like I said, a group of companies, like a fund of companies, and so your exposure, your risk is diversified amongst this group, right? So let's say 5 companies go bankrupt. It's not like this fund is going to collapse because you've got so many other companies. To give you examples of companies that have come out of the Titan VCT, for example, is you've heard of Kazoo. So Kazoo was once a part of this fund, and of course now you can see vehicles all over the place with this Kazoo brand. So that went IPO. Zoopla is another company that I believe went IPO as well. It was also backed by Titan. So there are some big names, Secret Escapes, and there are some other companies that are well-known names which have been backed by these funds. So it's something that I think I've done work with in the past. So a lot of my clients have invested into not only Titan funds, but there are various VCT funds which are open throughout the year. And so this is something that if you're looking at saving some tax or getting some tax relief, one area to look at, VCTs. Just touching on tax implications and reiterating this, 30% tax relief on investments made, and every year there's a maximum of 200,000 you can put into a VCT or multiple VCTs. Capital gains are tax-free, so there's no capital gains tax. Every year you get tax-free dividends, so again, incentive for investors. There's no loss relief. So I'll come to loss relief when I speak about EIS schemes, which are similar to VCTs, but there are different tax advantages for EIS as compared to VCTs, but I'll come to that in a bit. So just to show you an example of what a VCT investment looks like on your tax return. Now, this client has, let's go through this, has pay from employment. So he is a full-time employee earning, a gross salary, PAYE. He has got some self-employment income here. But what I want you to see is this dividends. So he's got a company that he does consulting on. So he's also employed full-time, but he also has a consulting company. Now, because he's employed full-time, he earns so much, he earns a high salary, right? He's not able to withdraw dividends from this company because he's going to be paying the high rate of dividend tax because he's a high rate taxpayer. So because of that restriction, all his private income, the consultancy business is just growing with cash, right? The business account is just accumulating with cash. So what he has done, he's taken a dividend of 100,000. Now, this dividend of 100,000 is going to if he didn't invest in a VCT, he would have had to pay 39% as dividend tax, because that's the additional rate of dividend tax, right? Because he's an additional rate taxpayer. But because he's invested this 100,000 into a VCT, he gets 30% back. So you see here, venture capital trust relief, he gets 30% of the 100,000 back as a relief. So this shows you the additional rate dividend tax calculation that he owes to the HMRC because he took a dividend out of the business. He owes 39% to the HMRC, right? So that's the calculation of what he owes to the revenue, 38,500. But because he's invested that into a VCT, he gets 30,000 as a relief. So net, he only has to pay 8,500 of dividend tax on the 100,000 withdrawal, on the 100,000 dividend withdrawal. So you can see here, this example not only shows you what the tax relief looks like, but also business owners who are finding it, you know, basically difficult to withdraw their profits as dividends due to various reasons, right? You could be a high rate taxpayer, so you don't want to unnecessarily pay more tax for the dividend. So invariably, your earnings, your retained earnings in your business just grows and grows, and you don't know what to do with it because it's just sitting there in a business account. So this VCT is one way of extracting your profits from your business in a very tax efficient way. But it involves you investing those dividends into these schemes, right? And in that way, you can sort of minimize the dividend tax you pay. So hopefully that's clear. And it is a good example of a high rate tax payer who gets, who's getting such a big relief on dividends he has withdrawn but invested into a VCT. EIS. EIS is EIS stands for Enterprise Investment Schemes. They're very similar to VCTs, except when you invest into an EIS, you're not investing into a pool of funds. You're not investing into a pool of companies. You're investing into individual companies. And so what this diagram is showing you is, okay, let's say that 10,000, instead of a VCT, you put into an EIS, that the 10,000 gets split into, let's say, 5 companies. You call it company A, company. So you then own the shares of, or part of the shares of company A, company B, company, so on and so forth. So you're actually a shareholder in these companies. Now, because of the nature of EIS, you're owning the shares of these companies, there's more risk, right? There's more risk because 5 companies, from the 5 companies shown in this diagram, 3 can go bust and 2 can really hit it up. So with EIS schemes as versus to VCTs, with EIS, you're looking for that, 20 times X, 10 times X. So a lot more capital, a lot more return for your money because of the risks involved. Unlike a VCT where you're looking for regular dividends, tax-free dividends, so like an income stream. And VCTs, as compared to EIS, don't give you that capital uptick. Your 10 grand may become 12 grand in 5 years' time, right? Whilst with an EIS, your 10,000 investment has a chance to quadruple. So there's, again, risk versus return. And because these, I believe EISs are more riskier, the government gives a little more tax advantages, so tax reliefs. So just to go through it, so again, 30% income tax relief, just very similar to VCTs. You put 10,000 into an EIS, you get 3,000 back, in just like the VCT. But unlike the VCT, there's something called a loss relief. So in that example, where if you're a high rate taxpayer, if one of these companies goes bust, and let's say your loss is £1,000 of your 10,000, because you're a high rate taxpayer, you also get 40%, because 40% being the high rate of tax. you get a 40% loss relief as well, which you can claim in your tax return. So 40% of 1,000 is what you can claim back from the revenue. So there are two types of reliefs here. One is the 30% income tax relief at the beginning, and then later on, if any of these companies go bust, you also have loss relief. Tax-free growth, similar to VCTs, any capital gains that you make on this portfolio are exempt from any taxes, so no capital gains tax. You can defer capital gains. So for example, say you've sold a property, say it's your second property and you've sold it, there's a capital gains tax that you now need to pay. And say that gain you invest into an EIS scheme, you don't have to pay that capital gains tax. You can defer it. So at some point in the future, say 3-4 years from now, when these EIS companies go IPO or get bought over, or it comes to an end, you have to pay that capital gains tax at some time in the future, not today. So you can defer your capital gains tax. Business relief, again, this is something to do with inheritance tax. Again, if you own shares of a trading company for 2 years or more, and on death you're still holding these shares, the value of these shares don't form part of your estate for inheritance tax. So there's a lot of inheritance tax planning that goes on behind EIS schemes as well. So I hope that diagram is clear and the tax benefits are clear. Again, just to reiterate, these are small to medium-sized companies, again, high-risk companies, and there's a bit of tax breaks for investors. So with EIS, you're looking for a lot of high growth. So a lot of, like I said, 20x times, your capital invested, and basically the companies that we're investing into are in the innovative sector, the emerging market sector. Unlike VCTs where you have to hold it for 5 years, the minimum holding period for EIS is 3 years. But in practice, these companies usually you're holding these shares for 6 to 7 or even 10 years. You don't know, because how you get out of EIS schemes is these companies have to either be bought over by the likes of the Facebooks and the Googles, or they have to go IPO, so they get listed, and that's how you can part with your shares. So unlike VCTs, where after 5 years, the fund will buy those units back from you. With the EIS things, you're basically stuck with a share certificate, and you're hoping that at some point in the future, this company will grow big enough where one of the bigger companies will buy it over, or it becomes listed. So that's one of the things to consider. There's a lack of liquidity in the EIS markets, right? Okay, so just again to recap the tax benefits: 30% tax relief on year one, and like VCTs, it comes on your personal tax return, so you're recouping some of that tax you've already paid, in employment or what have you, dividends. And there's a maximum 1 million you can put into EIS per year. Capital gain, so no gains tax. So whenever you part with the shares, if there's a huge capital gain, there's no tax to pay there. Loss relief, as I said, unlike VCTs, EIS carry loss relief, which is also a good point to note, because again, the revenue is incentivizing investors who take a little more risk, right? Okay, so pension contributions, this again, another way to sort of get some tax relief. And here I'm talking about individual, personal pension contributions, not your employer contributions, because usually that's taken from your salary, from your gross salary. So your all the tax benefits are at source there. But here, if, for example, say I've got some savings and I want to sort of be a bit tax savvy, if I contribute to a pension from my personal money, there are some tax relief that the HMRC gives me. Now, for example, if I was a basic rate taxpayer paying 20%. If I were to put £80 into my personal pension, the government would give me £20 on top of that 80. So the pension provider will reach out to the government on my behalf and get another 20% top up, right? So £80 will become £100. And so I get basically a 20% relief gain by making a pension contribution. Now, for higher rate and additional rate taxpayers, there's a lot more benefit. So if you are a higher rate taxpayer, you not only get the 20% top up from your pension provider, but when you do your personal tax return, and I'll show you in a minute an example, you also get another 20%, call it a bonus relief, right? Where the revenue will give you back some tax. So all in all, a high rate taxpayer will save as much as 40% on their contributions, on their personal contributions. So in this example, to get £100 of pensions, effectively you're only paying £60 into your personal pension, and the government is adding the other 40. So a very useful way of getting those add-ons and the reliefs, tax reliefs, right? So, okay, for example, a lot of you who have joined in are business owners. You can pay into pensions from your company. I'm not talking about that contribution because that's the employer contribution. The company is saving corporation tax, and so that is not part of what I'm talking about here. Here, I'm only talking about personal contribution. So, say a contribution from your savings, your personal savings, right? Not business savings. And yeah, just a point to note, you can put up to 60,000 gross per year into a pension, not only from your company, but also personal contributions from your employer. Everything has to add up to a maximum of 60,000 a year. So yeah, an example of how the pension relief works. So in this example, again, it's a person who's a higher taxpayer, has some income from property, and this person has put a gross of 22,000 into a personal pension. So effectively, this 22,000 is topped up by that 20%. So he would have put something like, if you divide this figure by 1.25, you'll see, you'll work out how much that person has put in. So it works out to about 17,000 odd pounds. So he would have put up 17,000 pounds into his pension. The pension provider has topped it by 20%, and that's now become 22,140. So you can see, by contributing that amount to a personal pension, what happens is your basic rate threshold increases. So usually for someone who hasn't put anything into pensions, the threshold is about 37,000 in the UK. So from your total income, which is taxable, 12,570 is your personal allowance. So that amount of income is not taxed. And then the next 37,000 odd is taxed at 20%, right? When you put into a pension, you make a personal contribution, that 37,000 increases by the amount of pension contribution. So in this case, the 37,700 has increased by 22,140 plus another 610 he has put for gift aid. Together, his basic rate threshold has increased by 60,450, which means of that income which is taxable, 60,450 is now being taxed at 20% instead of a lot of that chunk being taxed at 40%. And so that's how, through your personal tax return, you get that extra 20% top up on your pension contributions. I hope that makes sense. So in this example, a lot of his income is taxed at the basic rate of tax, only because he's contributed so much to his pension. And you can see, after all the workings, he's getting some tax back. And that is not a direct consequence of his pension, but also he's got some relief from financing costs from the land and property income and all what have you. But the example here is just to illustrate how a personal contribution into a pension can not only get you the 20% from your pension provider, but also a further 20% from the HMRC when you do a tax return. So things to note here. And like I said in the beginning, this is the tax season. You have paid your taxes. You know how difficult it is to part with that money. I'm just showing you ways of how to reduce that or get some relief or get some tax back. Pensions being one of the best ways of doing it. And of course, pensions, you're saving for your retirement. Yes, it's an investment, but it's a long-term investment. You can choose the level of risk here in pensions, unlike VCTs and EISs, which are high risk, high return type investments. With a pension, you can go low risk. You can you can choose funds that are low risk or medium risk or even high risk. So there's a lot of flexibility around choosing what risk level you want your money to be invested in. But because it's a long-term investment, you cannot touch your pensions until you become, until you reach the minimum pension age. So consider this as a long-term saving. You're putting your personal money away for retirement. And whilst doing that, you're getting a major, major tax benefit. So that's sort of the message here. With VCTs, EISs, yes, they're shorter term investments as compared to pensions. One is 5 years, VCT. EIS, in theory, 3 years, but consider that to be a 5-year, 6-year investment as well, which as compared to a pension is a shorter investment time frame. So you get your money sooner, but it comes with risks. It's a high risk, high return type. If you remember the graph, EIS and VCT sit on top of the risk scale, right? So a lot of things to consider. I hope that pension is, so I'll touch on ISAs. These, of course, don't give you immediate relief, unlike the other 3 products I spoke about. It does not go onto your personal tax return, but it's there to be used. If you're not utilizing ISAs, I encourage you to do so rather than holding money in your savings account. You might as well hold it in your ISA account because you want your ISAs to grow. Any returns that are tax free, you can invest your ISAs into stocks and shares, which also give you returns. So you get market returns, dividends, all tax free, and so those are accumulating. You can put up to 20,000 per year into an ISA, and so utilize it if not done already. But it's a very tax efficient way. End of the day, you want all your savings in ISAs and not sitting in current accounts and savings account. You want it sat in an ISA because of all the tax benefits. NSNI, again, since we're on the saving subject, is something to must touch upon. My favorite of all this is the premium bonds, which again, they don't give, so anyone can open a premium bond account with the National Savings and Investments. It's very easy to do. You can do it online. You can put up to £50,000 in one of these accounts. And what happens with premium bonds is you get prizes. So every month there's like a lottery, and for every £1 you put into a premium bond account, you get one bond number, right? So if say I put £10,000 into it, I get 10,000 bond numbers, and that means my entry is I'm giving myself 10,000 chances of winning that lottery. And how the prices work is prices range from £25 to £1 million. So you're giving yourself the chance of winning anywhere between 25 to £1 million, right? Every month. And because it's backed by the government, this is backed by the Bank of England. This is your capital is not at risk. Consider this a very, very safe investment because it's backed by the government of England, right? And so capital is not at risk. You have a chance of winning a prize. And I've spoken about this before, where say, every January you pay your taxes, or in case of business owners, knowing that you have to have you pay corporation tax, you can put that money aside. So if you know you're going to pay tax in your self-assessment, you know in 10 months' time I've got to pay, say, £5,000. You put that £5,000 aside now, and put it into a premium bond account, so you know it's safe. Your capital is at safe, and you're giving yourself the chance of winning winning the prizes or every month. And in January, when you know you have to pay these taxes, you withdraw the money. You withdraw your £5,000 out, and it takes 3 working days for the NSI to pay that money back into your personal account. So it's very safe. It's a very safe way of putting your money aside. You need for expenditure in the future, right? And you stand a chance of winning $1 million. So why not? Why have it in a savings account when you can give yourself the chance of getting something a lot more without your capital being at risk? So premium bonds is that. I mean, there are other ways of saving, and some of these are tax incentivized as well. So I won't go into all of it, but consider premium bonds. But I think that's about it for savings. I mean, the savings instruments. Just to touch on what we're going to do next is, I think in the next webinar, this is really sort of key for business owners. Again, a lot of our audience here are business owners, and they in different scenarios. I have clients who rent their own office, or who have a lot of money in their business account not doing anything. And what I'm going to talk about is how we can utilize that money, contribute to a pension, and the pension buying commercial property, right? So this is a way of utilizing business savings, or even individual savings, which are in a pension pot, utilizing that pension to buy a commercial property. And there's a lot of tax advantages here in this scenario, especially for business owners who are renting their office and wanting to buy that, for example. It's a very tax efficient loop. So I'll talk more about this in our next webinar, but I think, Shian, we have to give some time for Q&A. I think we have some time, but I hope that was clear. So
there are a few questions, yeah. So talking about VCTs and EIS, Sunit, could you just fill us in on what the minimum amounts of investments are like for each?
Okay, so yeah, that's a good question. So VCTs, minimum is £3,000, depending on the VCT, but generally it's about £3,000, the minimum. But with EIS, given the nature of that investment, and depending on the intermediary you're going through, you could be looking at anywhere between 15 to 25,000 being the minimum, right? I hope that's clear. Yeah, 3,000 for VCTs. I would say on average about 20,000 for EISs. Some providers, there's a lower investment amount, but some of the bigger ones that I work with who are more established, it's about 25 grand.
In terms of preferences, how flexible are they in terms of ESG, Sharia compliant funds, and all these things? Do we have these options with VCTs and EIS, or?
Okay, so Sharia compliancy, not on EIS or VCTs as far as I'm aware. But in terms of ESG, yes. ESG, there are funds out there that solely sort of look at the social governance aspects of their investments, or the companies that they choose. And so if someone is wanting to explore more ESG opportunities, there are both VCT and EIS options out there, where these companies or rather the intermediaries have put in a portfolio of firms that meet the ESG criteria. So yes is the answer to the second question, but
yeah.
Sharia compliancy, that's, as far as I'm aware, is not available with VCTs or EISs. But with EIS, we're again, you're looking at dividends as returns and capital gains. There's no interest component there. But VCTs may have interest in there. It's usually dividends. As far as the nature of the business goes, there's a lot of due diligence that happens from the intermediary who's selecting these EIS companies and the VCT companies. And, we could look at funds that, when it comes to Sharia compliance, where, these companies are, for example, not investing into weaponry or whatever. We could look at that, but again, a rule of thumb, it's not like we have a certificate from it from the fund being Sharia compliant.
Right. That's pretty much all the questions we have. And yeah, we could take a few more questions. We have about 15 minutes left on the session.
Okay, good. I hope everyone is clear with the calculations and clear on, how, for example, a pension contribution has a double whammy effect on
So we do have
the benefits.
yeah,
Yeah.
so we have a few questions. So what is the minimum pension age in the UK, and is that going to change? What are the chances of it changing by the time, someone in their late 30s when they retire?
Okay, so good question. The minimum age is 57 now, and it was 55, and this changed. About 4 years ago, it was 55. It changed now, and so it's going up. So the trend is, and there's potential for it to increase as well. So now being 57, it could be 60 in another 10 years' time. State pension minimum age is increasing. It used to be 65, 66. It's now becoming 68. So the trend is it's going up. So when on average, when I look at our clients and their age groups, when we do retire, it's not going to be 57. Let's be honest about it.
The next question is, can I get a loss relief if I invested in an AIM-listed company directly through ISA or another option, or is it only applicable for EIS investments?
Yeah, so that company, which is AIM listed, has to have an EIS approval from HMRC. So if you have shares of an AIM listed company, ask them whether they are EIS registered with the revenue. And if they are, then yes, you can have loss relief if that company goes bust. But you have to have that EIS tick from the revenue. So not all AIM listed companies are eligible for EIS or have been approved for EIS. I hope that's
Apart
clear.
from that, are there any other benefits apart from tax-free prices in NSNI premium bonds, like interest or maybe monthly payouts?
So there's no
In
interest
terms
on
of,
premium bonds.
yeah,
There's no interest on there. You're just hoping for a prize every month, right?
yeah.
And you can have months of no prizes, and you can have months, of multiple prizes. And so it's a chance. It's not like a bank account where you're going to get some interest. Here's you're playing on on probability, and if you have a good amount saved there, the chances are higher. So the more you save into a premium bond, the more chances you're giving yourself of winning something. And more recently, the government is encouraging people to save because, of course, they want to bring inflation down, so they want less expenditure. So they increase the probability of winning a prize on their premium bonds, so that more people will save. And likewise, when they did that so as to curb inflation. And likewise, if they want to, if they want people spending, they will decrease the probability. And so people will think, why save in a premium bond when I'm not getting any prize? I'll spend it or what have you. So yeah, there are those connotations to it. But as of now, it's a good time to save because inflation is curbing, but still there are measures out there to curb inflation further, right? And so the government has increased the probability of someone winning something on their premium bond accounts.
We have another question here. VCT and EIS investment. How can one go on about this? How can one invest in this? The road to the market,
Okay,
basically.
so if you are an experienced investor and you've taken risks before, you've had experience in dealing with stocks, equity, you can go directly to a VCT provider and choose or get advice via them. It's slightly more expensive when retail customers go directly to the intermediaries. Or if you don't have any experience in this, or you want advice, you can go through a financial advisor like myself. And there you get, there is support, there's sort of advice that you get if you go through a financial advisor. And also financial advisors, the VCT providers and EIS providers prefer you coming through a financial advisor, because then they know their investors are fully sort of advised on the risks and the capacity for loss and all that. So a lot of these VCT intermediaries, they encourage their clients to come through IFAs. And also IFAs get discounts, early bird discounts and what have you. So I would say initially, if you don't have any experience, speak to an IFA. But if you do, and if you're an experienced investor, you can go directly to, for example, Octopus and say, I want to invest in the Titan fund, and they'll let you. Charges are slightly higher, but they'll let you. You can go directly.
Also, this one is not really a question, it's more of a statement that's been said, that it's the retirement age, the minimum retirement age in the UK is still 55 till 2027. So there is a chance of it being taken up to 57 in 2028. So like Sunit said before, that the chances are that it will get a bit higher over the next few years. And we have another question. In premium bonds, are the price based on per bond or for overall investment? So just
per bond. So per bond. So like I said, a 10,000 investment, or it's not an investment, a 10,000 deposit into a premium bond will give you 10,000 bond numbers. And this lottery is all bond numbers of everyone owning premium bonds. Is just, it's random pick of bond numbers, right? So one bond number. So if you got £1 in there with one bond number, you could have a chance of winning $1 million. That's what it is. So it's not your total investment. It's the number of bonds you have. So each bond is eligible for a price.
Hope that's clear. Yeah. We do have about 10 more minutes left. If you have any questions, you can just pop it in the chat now.
But good, some useful questions there. Again, if just to note, anyone here wants more info on VCTs, EISs, personal pensions, company pensions, anything to do with these products or premium bonds, ISAs, please feel free to reach out to us. I can have individual sessions with you all, just to detail more on these instruments. Like I said before, it's not for everyone. There's a lot of factors to consider, and so it's best you get advice before you put your money at risk.
There's one last question about the commercial property incorporated in the pension. So it's just asking about the return on investment of it. I think it's more of a session on its own. And once we have the date set up for that, we'll send out the invite for that as well. But yes, we'll be talking about
that session.
Yes.
We'll delve a lot deeper into these tax incentives, the returns, and how that all loops together. And it's a brilliant vehicle for investing into commercial property. I think one of the best things available out there to invest your pension money into.
There's another question we have. Can I invest in pension from both company as an employee contribution and a personal pension?
Yes, you can. And just make sure that both combined are not more than 60,000 gross, because that's your limit. That's your individual limit for the year.
Yeah. And there's another question. I think it's more of a statement. Crowdcube is one of the crowdfunding and does EIS investment. Is it as same as EIS discussed here? The crowdfunding platforms that we normally come across.
If they have EIS schemes, the features are the same. But with crowdfunding, there's, the amount of due diligence they sort of have on the companies that they're picking is, I don't know is the answer. I don't know to how much, to the extreme of, the company, the intermediaries I work with, the likes of Octopus, Blackfinch, Deep Bridge, these companies, they're not crowdfunding. They take a lot of time in picking their companies into their fund. So when I say a lot of time, they spend a lot of due diligence on questioning the directors of these companies for the plans they have. They go through in depth the numbers, the projections, and not only that, the intermediaries have one of their directors sitting on the board of these companies. So that director, though is a silent director, is there to ensure that these EIS companies are doing what they promise they'll do. So they're ensuring that the investor money is being worked on, is being used as it's, as it was meant to be. And so there's a lot of, like I said, not just initial due diligence, but continuous due diligence. As long as these companies are on the books or in their funds, there'll be continuous due diligence. I don't know if that same amount of due diligence has been practiced on crowdfunding. So crowdfunding is not something I've looked at or advised on. IFAs usually don't do that. But I believe there's a bit of risk there. There's more risk to be had. But again, do your research, do a lot of due diligence before you put your money into it.
Hope that helps. And there's another question in it. Can I invest in premium bonds from company revenue?
No, it's an individual. It's an individual account. So NSNI won't let you open a company account in the name of a corporate. No, it's always an individual. So it's a personal investment. So you can draw dividends from a business and put it into an NSNI. But it has to be a personal account you open with the NSNI, not a corporate account. But that's a good question.
We do have 5 more minutes left. We do have 5 more minutes left. So if you have any questions, you can just pop it in the chat now.
Okay, good. If there aren't any more.
Yeah, that was the last question, I think. There hasn't been anything after that.
Okay, that's great. Thank you everyone who joined, and I hope this session was useful. I think Sean will share the recording of this as well as the slides. Again, like I said before, feel free to reach out to us should you need more advice or guidance on these investments. And again, thank you. Thanks for joining.
All right. Well, one thing, quick one. There is another one. I think we've already covered this, but let's just touch base on that before we go. The returns from NSNI, will it be tax-free? So it's more of a chance to win the lottery? From the lottery, I think that's what they mean. Yeah.
Yeah, any lottery winnings are tax-free in the UK, whether you win the Euro Millions or the Lotto, they're all tax-free. So any winnings on the premium bonds is tax-free.
Oh, I think this is probably the best question so far. As a financial advisor, which one would you prefer best? What's your personal recommendation?
I would put money into the various buckets that I spoke about. I won't put all my money into one. Again, that's sort of the rule of investing. You diversify your investments. You don't put all your eggs in one basket, as they say, right? So I would put some in VACT, some in EIS, more in pensions, because that's your retirement fund. I'd like to have a lot more in pensions. ISAs, I like to have all my savings in ISAs, but my investments, I'll have, some in VCT, some in EIS. Generally, there's a rule of thumb: you shouldn't have more than 10 to 15% of your total wealth in VCTs and EIS, not more than 15%, because these are high. Don't forget, these are high risk, high return type category investments. So chances of you losing money is higher. And so, anything up to 15%, reasonable. A lot of the other chunk of your investments should be in ISAs, pensions, and of course premium bonds. It's a matter of diversifying your wealth, right, and your investments. So I won't put a lot of money into one bucket.
So that's about it for today. And thanks again, everyone, for joining. I'll make sure you get a link to the recording and the slides over the next 2 days.
Thanks again, guys. Thank
you so much, Sunit, for your time and your input as always. Thanks, guys.
Okay.
Take care. Bye-bye.
Thanks a lot. Bye-bye.